So Louisiana, given where we are in the world, everything that's going on, everything that's in the news at the moment, for our clients where they care about this and they want to make a difference, obviously they can do that in the way that they run their lifestyles. But what about their money? What kind of things can they do to make the world a better place?
Yeah, so I mean, if you think about your pension investment or any cash that you have saved up, one of the ways in which you can create a better world for yourselves and people around you is by investing it with, I guess, a conscious mind to sustainable outcomes that might derive from them. And you can start thinking about what types of companies you might want to invest in, what types of companies you might want to avoid because they're making, the issues that we're facing at the moment worse. And you also might think about the shareholder rights and the power attached to money when it's invested and using that to drive change in companies that might, on the right track, but could help with a little bit of push.
Brilliant. Okay. So that's a really good start. So you talk there about the companies to avoid. So give us some sense of how you, as an investment manager, will pick those companies. What are the sectors at the moment where you see harm being done, where if our clients avoid investing in them, they're keeping capital away from those places?
Correct. So we don't want to impose our ethics on your clients because we understand that, these are highly personal things. So what we try to do is we reference globally agreed upon frameworks that kind of define what is a need of investment to make the world a better place and what is something that should be drawn away from. And we use the likes of the framework of the UN Sustainable Development Goals, there's 17 of them, to try to, I guess, differentiate which kinds of companies we want to hold in our portfolios and which ones we want to avoid. Going to those that avoid, there are some sectors that are more gray. There, if you think about the utilities, electric utilities, some of them are close or 100% renewable already. Great, we want to invest in them. They're doing, for our clients that, and want to invest sustainably, they're doing a great job to make the world a greener place and combat climate change. There are utilities that are still investing in thermal coal expansion. That's the dirtiest fossil fuel. That's the kind of company that we want to avoid. So there's nuance in some sectors. Then there's sectors that we don't see, I guess, a transition forward or a sensible transition forward. For example, tobacco, gambling, some parts of the defense sector as well, and very importantly, fossil fuel expansion and production, because at the moment, none of them have a net zero aligned plan to transition.
Brilliant. Okay, so what I'm hearing is there are some areas that are just absolute no-goes for people to invest in. And you talked about grey areas. I mean, a hot topic at the moment is water companies, obviously, given the state of our rivers and our seas and a lot of controversy around that particular sector. What can you do with a utility like that where there ought to be some good, but clearly there's some bad practice, particularly bearing in mind part of the controversy is that all of those companies are private and investable in for our clients at the moment?
It's a great question. So water utilities in the UK have been challenged in some degrees. One of the reasons is because of the lack of their historic investment in infrastructure, and now they're paying the price for that, right? The issue with that particular investment is that we don't usually invest in the company itself. We invest in the bonds that they issue. And that gives you slightly less, engagement leverage over those companies because you're not a shareholder, you're kind of subscribing to some of their debt. And that means that the engagement tool that is usually in the investor's toolbox isn't as strong as you might think it is. So while some of the investment managers that had historically invested in them try to engage with them, in many cases, this is no longer an investable, security in the sustainable investment framework. What we can do, though, is invest in companies that are helping basically almost the products and services that would help the likes of Thames Water improve their practices. So, for example, a company that provides smart water metering, stormwater overflow systems, really important with climate change impacts. So we're kind of trying to think about the water theme in a bit more nuanced impacts, not investing in those that have historically shocking corporate behavior, and then moving towards the solution providers that could help them, turn around with new spending packages that have been announced from them.
Brilliant. So you talked about two important distinctions there. investing in the equity, so the shares of a company, and then investing in the bonds of a company, so loans to a company. So with the equity, you've got more opportunity to influence what they're doing. So I guess that's turning up to AGMs, voting. Perhaps we can come back to that in a little bit in terms of what you guys are doing to be active in that space. But because you mentioned bonds, just looking at that, equities, so shares in a company, are a little bit easier for the average person to understand because most of us see the stock market, the movement of the stock market on the news. It's the thing that makes the headlines, right? If it crashes rather than rockets in value. But owning a stake in a company is an easy to understand concept. Bonds, I think, typically are less well understood by most investors. So what would be interesting is not the technicalities of what a bond is, but what are bonds for you as ethical investors, and what's the difference between the things we hear out there around green bonds or blue bonds? Can you just unpack some of that for us?
For sure. I mean, I actually think that bonds are one of the most underappreciated tools in the sustainable investors and impact investors toolbox. What they allow you to do, it's essentially any entity, a government, a municipal or corporate, can go out to the market and raise capital, borrow capital from the market. Some people might choose to give them that, and some people might choose not to. If they do, they can be raised and packaged up in a form of a bond. Green bonds, blue bonds, social bonds have conditions attached to that package. So when you're willingly giving your capital away, you can be sure that that capital will be used for a specified project. If it's a green bond, it can be a specified renewable energy plant that's being built, energy efficiency infrastructure that is implemented in buildings of that company or that municipality, water infrastructure that is being substantiated. Social bonds could be things like investing in new social housing projects from housing associations around the UK, or investing in school infrastructure, or new GP surgeries even. And so as sustainable investors, we can kind of trace, in a way, the client's capital all the way through to the end result. And by the nature of these bonds, they need to report quite transparently on this. So sometimes we even know exactly how many social housing units have been provided by a social bond. So it's a really nice kind of greenwash preventative way of investing in sustainable things.
Yeah, so it's interesting. So bonds, by the sounds of it, can be more specific in your space. Whereas if you're investing in the equity, the ownership of a company, then that's you just have to take every action the company takes, right? The good behaviors and the bad behaviors with it. So absolutely makes sense. In terms of what you talked about, your ability to influence companies, if we go back to investing in the shares of a company, not all companies are good in their actions, as we know. Some are bad, those can be excluded. Some are going to be in that grey area where they're doing some good things, some bad things. What do you do as a company, as EQ investors, to make your views known to these corporates and to the boards? How active are you? How does that whole process work?
Great question. So EQ investors mainly invest in funds, which then invest in either securities, for example, shares or bonds. So we have a multi-layered approach to this because we understand that we can kind of influence in different ways. The first way in which we do it is make sure that the fund managers that we pick and we choose to partner with do the right job when it comes to stewardship, so voting and engagement with the companies. And you'd be surprised how crazily different certain asset managers use the voting rights of their clients versus some others. To give you an example, there's environmental and social resolutions every year that get put to companies. What that means is a shareholder might come to a company and say, actually, you don't have a net zero plan. I really want you to have a net zero plan. If 50% or more of the shareholder votes support that plan, support that resolution, it goes through. Right. So what do we want as sustainable investors? Well, we would like them to support these kinds of resolutions that would bring about positive sustainability change. There's a huge variety of asset managers that would vote for 0 or 1% of these resolutions, and some that would vote for 90 plus. So first of all, we want to make sure that we're in that range rather than this. Second of all, we have really clear oversight of where best practice lies between these asset managers. So we pick very strategic themes: biodiversity risk, climate and banks, healthy nutrition, social safeguards and supply chains, and we kind of cross-pollinate best practice between them, and we track progress over time with milestones. So all of this is at the asset manager level. Now, what do we do with the underlying companies? So we partner with different other investors in coalitions or collaborations, because sometimes it's great to call them up and say, I would like you to do this, but it's much more powerful if you're there with a bunch of other people saying the same thing. So we will usually match each of our strategic themes, which I just mentioned a few of, the biodiversity and climate change, with a collaboration so that we can get access to the underlying companies and directly get on calls with them, go to the board meetings and push them on their identified weaknesses. And then lastly, we go to annual general meetings ourselves. Some people in our team at EQ do that. So far only in the UK, because we don't want to fly anywhere for that sake.
That is a bit counterproductive.
It is, isn't it? Exactly. So I went to the AGM of Rio Tinto, a big miner, actually not held in most of our portfolios, but we understand that it's something that needs to be pushed to the right way, because we're all reliant on minerals. Yep, we're kind of excluding miners, and then what's happening in the supply chains of that. So I was there to push them on that front. Damien's gone to Standard Chartered, which is a bank, and pushed them on their net zero commitments directly at the board meetings. So yeah, many different ways in which we can do that.
Brilliant. Sounds great. So I mean, we are as a firm on record as being a bit not cautious, and maybe not as much as negative, but very wary of the idea that you can influence some of these big corporates in terms of their actions. We've historically taken the approach that we would prefer to not give client capital to firms who are going to misbehave, given the choice. But convince me with some actual rock-solid examples of progress that actually voting and turning up to AGMs and coming in coalition and putting pressure on these boards has had a positive impact. Can you point to things that have changed as a result of the pressure that you and others have applied?
Yes. However, I would want to clarify that not all companies are engageable. So we do share that view with you, and that some companies, you're wasting your time. Either it's because they're so locked into their kind of bad business model that, a gambling company is not tomorrow going to do toys or something, or renewable energy production. So there's some where it's too locked in and you're wasting your breath, right? Or the risk is too high that it's going to fail, and your client's capital is invested in a business that has huge risks attached to them. So that's true. Sometimes it's not engageable because the shareholder structure is so that they're kind of controlled by one party. So if you're a minority shareholder, you're not going to move the needle. But there are many examples in which there is concrete evidence. The biggest coalition of investors engagement coalition is called Climate Action 100 Plus. The purpose of it is to bring investors together to engage on the 100 plus biggest polluters in the world. So all the nasties you can think of, the Chevrons and the chemicals companies and everything you can think of. And in the beginning, when it was launched, and that was like 2018, I think, 5% of the companies that they had shortlisted had net zero plans. Now it's about 80. And I understand that there's other factors involved, but these very considered, structured engagement programs by lots of their investor base definitely contributed to that. Direct examples of EQ's approach. So this is a smaller story. We went to another miner's AGM last year called Antofagasta, copper miner, UK listed, but mainly working in Chile. We realized in their annual reports that they weren't clarifying how they do due diligence on the community impacts, right? They were saying we do it. And we were like, well, that's not quite clear, because how do we know that you're doing it in what consistent manner? And are you going to disclose the outcomes of that transparently? Otherwise, if you're not disclosing the policies, no one has, let's say if you are a community member out there and you're not, you don't see a policy that allows you to issue your grievance, you cannot do that. There's no legal mechanisms to do so. So we issued that weakness to the board there. And this year in their report, they have not only restated their policy, so it's public, so there's a legal backing to grievance mechanisms. They've also showed the results of the audits of these community impact assessments, which provides the transparency for investors. So that's like a nitty-gritty example of how you can change.
Perfect. So I mean, obviously, that's the engagement side. Then, if we're talking about those sectors that, as you say, are just uninvestable because they're, the whole business model is structured in a way that it is always going to be doing bad. They're pursuing a profit to a negative impact. You're going to avoid investing in those sectors and those companies. What evidence is there, if any, that a lack of investment is holding those companies back? Is there any evidence that has had an impact on those corporates, or is it the case that there'll always be some money that will find that will be happy to invest regardless of what the company's doing?
Yeah, so there is some evidence to the divestment movement working. Yeah, so the best example you can think of is thermal coal, the dirtiest fossil fuel. There's been a consistent effort from across the investment, space to start divesting from companies that continuously either mine coal or generate electricity from coal. What happened then is that was picked up also by the banks who lend to those miners and those electricity providers, and the insurance companies that insure those miners and those electricity providers. So altogether, what would happen is that it raises the cost of capital for these businesses to do what they've been doing, the nasty stuff that pollutes our climate. And it is very true that there has been stranded assets, essentially. So this is the way to call assets that previously had a value, now don't have a value because you cannot economically create money from digging things out of the ground anymore. And people have written off assets, miners have written off assets that will remain in the ground because they're no longer economical. And I do think there's other things to play. Renewables are becoming more economical, great. But this cost of capital increasing definitely does have legs in the investment movement too.
Great. So actually, it's not that the cost of extraction has gone up; it's the cost of raising the capital
both
to do it.
We just discussed divestment and engagement and the power of that. How do you usually engage your clients with sustainable investing?
Yeah, so it's a good question. So I think the first thing is, anytime you're speaking to someone who's not a finance professional, you have to understand that there's a lot of jargon in this space, and a lot of it doesn't make any sense because it's not normal language, it's not everyday language that the rest of us use out in the real world. So actually the starting point is always the question. So are there things that you wouldn't want to invest into? And I think that's always a great way of opening up that conversation about what do they care about. Because actually some clients don't care about anything. They just say, well, I just want growth regardless of what you're doing. You almost don't tell me. And some people will say, well, actually, I'm passionate that I don't invest in this one thing. And it might be that one thing might be tobacco because they've experienced health issues because of that. Because of tobacco with a family member, or maybe it's gambling for a similar reason, maybe someone in the family they're aware of. So it might be a controversial area that immediately resonates, and that is more meaningful, and there isn't jargon in that, and that's about real life experiences and negative externalities that people have got real life experience and impact that they've seen. So that's a really good starting point, because that opens it up into, okay, well, then it's clear what our starting point is for what we don't want to invest your capital into. That's the easy bit. Typically from there, people will then break into, that's it, and that's as far as I want to go, and you can start the conversation about all the other, the sustainability or impact or screening, all those kind of things, but actually it's just not going to land, and that becomes evident fairly quickly. For some clients, though, they are super interested, and they're interested in going into the next level, which is really, okay, well, if we're not investing in X, are we positively investing more in Y? And if we're doing that, what is the theme or what is the approach that makes sense? So unfortunately, it is one of those areas in our world where every answer typically is completely different from every single client. So every client is a human being in all the wonderful complexity that comes with that. And so every client is bespoke, which is fantastic. It's then down to us as the professionals to find a solution that matches what that client is after.
That's great. I mean, as our house, we've worked together for quite a few years. We never thought that sustainability is one size fits all, right? And we need to find something that fits all clients, all the way from the low level of a couple of sectors of being excluded to impact investment portfolios that really focus on those positive solutions.
Absolutely. And I think what's interesting is the evolution of EQ Investors as an investment manager for us has been interesting to watch, because I think a lot of that's been driven by what our end clients have been asking for. So the development of a climate change theme within portfolios has been something that has definitely been driven by the COPs that we've had, where it's been brought to the front, where conferences have been going on. It's been gaining media attention about the issue of climate change. And so clients have been coming to us, and I assume coming directly to you, and saying, okay, how do I play my part in this? So it's been fascinating to watch how things have evolved from purely an exclusionary basis, or purely an impact, so positively investing or negatively investing, to something that's a bit more nuanced and sits in the middle of those. What would be great to talk about is where we are culturally with some of this stuff, if that's okay with you. Hopefully nothing too controversial. But whether you're seeing it, we get a sense that there has been a bit of a backlash against ESG or ethical or activist investing in the last sort of 2 or 3 years maybe, and particularly with where America is at the moment, a definite pushback on some of these things that have been prevalent for a while, or growing for a while, I guess. What's your view on that backlash? Where's that coming from? What's motivated it? How do you respond?
Yeah, big questions.
Yeah.
So where has it come from? I think there's 2 things. Sustainable investing has been bundled up as one thing, although it's quite different things, right? We all know that now. But I think there's certain parts of the sustainable investment themes that have struggled in terms of performance, matching up exactly to traditional investments, because they are investing in a subset of the market intentionally that will show different performance. So you end up in the same place, but depending on where you started in that journey, you might have had a very different journey to get there. So investors that have probably previously come in with a thought, or with maybe not necessarily ill-advised, but with the intention that they thought it's going to be exactly the same journey with all the sustainability on top, might have been disappointed and kind of fallen out of the race. I think that's one thing that we need to address, and we've been addressing it in terms of the way that we run portfolios, resilience and risk management through all of our portfolios now, and I think we're in a really strong place. The second thing that has been driving the backlash is politics and culture wars, particularly coming from kind of polarization in the US, but also in Europe, let's be honest, right? There's the rise of right-wing governments across that too. And I think what happens is that they're very loud, these anti-ESG movements, and so public perception becomes attached to those. But what you can see on the ground, and we are very close to the businesses and to the investors as well, is that often it doesn't necessarily translate into any difference in activity. So they might say they are changing their DEI policies, but what they're doing is they're continuously doing the programs of hiring and recruiting in the exact same way that they did before. They just might not call it that way. They might call it inclusivity, or they might call it culture, right? So there's a little bit of language movement away from to respond to that ESG backlash, where sometimes the action hasn't really been matched or downgraded in any way. So that's kind of a short answer to that. One thing that I want to just bring up here is I just recently saw a survey where loads of CEOs in the US have been surveyed anonymously, of course, about their approach to environmental, social, and governance, and what they're doing now that there's been push from the US administration to kind of lower their standards. And they said that despite the pushback, they continuously do it because they see that it makes financial sense for their businesses in the short term, which is less than 4 years, which is the entire presidency of Trump, right? Which I think is really interesting to see that CEOs, smart people, done this for a long time, really believe it makes sense financially to take care of stakeholders. And this is the reason why we think sustainability works and continuously works, whether or not it's like in vogue in the media or not.
Yeah, and that last point is probably probably the important one, actually, which is that it was maybe an unfair question of me, so I apologize, but we haven't seen any change in what we're being asked for from clients. If anything, probably they're becoming more aware, more concerned about how their capital is deployed and used, and what they're engaging with, and the impact that they're having with their capital. So I guess it is that, isn't it? It's noise, it's media, headlines a lot of the time, and it is probably a smaller subset of people being very more vocal about it. It's interesting what you say about what companies are doing, not necessarily reflecting. What they're saying, not necessarily reflecting what they're doing, but in a positive way. Because very often in this space it's the other way around. So it's interesting that they're focusing on those things. I guess from the perspective of the companies that you see and the actions that they are following through on, they're clearly taking a view that there are some negative things that could happen to their balance sheets, their profit and loss, if they don't address some of the current issues. Is that fair? I mean, are CEOs aware of climate change risks? Is that what's driving some of this? Yes. That it's a risk avoidance?
Yes, and it's an opportunity. I mean, a lot of the times when you're thinking about the energy efficiency plans, that will cut costs, operational costs of businesses. Or if you think about like fair hiring and workers' welfare, that's you get better talent and you retain that talent. So sometimes it's risk mitigation, and sometimes it's capturing opportunity to make your business more resilient or more competitive, for sure. Yeah.
Great, fantastic. So turning to a slightly different subject then. We as a firm, and again, I think we're fairly clear on some of the things that we put out there into the world, are sometimes, or quite often, slightly wary of active management, simply because the costs are higher. There's a lot of evidence that suggests that a passive approach is better from a pure performance perspective, we're talking here. Now, much as we don't tell our clients that they have to invest ethically or they have to exclude anything, we don't ever impose anyone's values on our clients. We say it's your money, it's your choice. We will find a solution regardless of what you come to us with. That doesn't mean that we don't have a view. And we have clients who are invested actively and paying that extra money, but typically it's because they want something very bespoke, very unique, something that can't be delivered by a passive investment. Now, I know you as a firm have both. You have one foot in each camp. You have passive solutions, you have active solutions, but I'm just really interested to hear where you see the value is in active investment management, and why is it worth a client paying a bit more sometimes?
Sure. Big question.
Yeah.
I think passives and actives have a role to play in sustainable investing, but you can only go so far in passives, because what you are reliant on, which is fine, and that's some of the benefits that you yield from it, for example, the low-cost approach, is that you're really reliant on data, published data that is being translated into rules that then construct what you end up investing in. So sustainable investing can only go so far in using specific public data and achieving some sustainability outcomes. What you can do with passive investing is you can quite easily exclude things that you really hate if it's a specific business model. But going back to those nuances that we just talked about, certain businesses need to be really in-depthly analyzed to understand their holistic impact. That's kind of where the gray areas, if you will, is where sometimes an active lens still has some value, because you need a human with the help of data, but also the help of judgment and the help of being able to talk to a business and kind of tease those nuances apart. Sometimes that's when you need it. We don't think you can yet do positive impact investing with a passive approach, because you need to be able to contribute to impact through either direct engagement or this really holistic assessment of a business and its products and services. But you can go far with passives as well. I just think if you need to be aware of some of the trade-offs that come with over-reliance on data and a data-driven approach, especially when there's going to be less disclosure in the future. But then also, of course, the drawbacks of a human making potentially right decisions, but also sometimes mistakes. another differentiator between passives and actives is the level and depth of stewardship. So if you are an investor that really cares about that change, you can vote in a passive approach, and we do that. We only go with fund managers that actually have a very strong voting track record. But you can't expect with all of the assets underlying a passive investments that there's going to be an engagement with every single one of them, right? Because you're paying less fees, there's less people working on them, there's going to be less engagement. With an active fund with much less securities underneath and a dedicated team, you can expect there's going to be a bit more active in that. So pros and cons on both, and different futures ahead for sure. AI is going to change this quite widely, probably bring down the cost of these data aggregations, for example, and be smart about how we make data-driven investment decisions. But
great. Yeah, so that was actually going to be my next question, because obviously a lot of what you're doing is about data, right? So it's about working out what these companies are doing, whether what they tell you matches up with what they're doing. So you must be very data hungry to try and work out what companies are doing, where you should invest, what you should avoid, how you get through to that company to actually make an impact, to make a vote, make a difference. Does AI help with that? Because AI is not great at all things. It's the way it comes up with phantom things that don't exist is somewhat worrying. But from the point of view of data, if you're looking for data, or if you've got a huge volume of data that you just need to crunch through, it feels like we're getting to a point where AI can do that in a much faster, more efficient, more accurate way than a human being. So does that evolution, is that bringing a change in investment management where you are able to drive costs down, whether that's drive costs down on the active, or whether you see that actually you get to a place where passives could deliver much more than they currently deliver just because of the power of what's being achieved by AI?
Yes, so definitely a way to use AI in order to data scrape and aggregate has been actually around for quite a bit. It's getting better now. I think one thing that we need to be aware of is that the frameworks that then assess that data for us to then make a judgment on the sustainability or responsibility of a business, there's ethics involved there and values involved there. And so I think devising the framework with which to analyze that data and then make judgment calls on that data, I think still there's way to go for the AI to take that over. So what we are seeing more of is a mix between kind of efficiencies on data aggregation and summing it up and creating great spreadsheets, essentially, but then still a human devising the judgment framework and the assessment framework with which that data then gets funneled into, let's say, an environmental, social, and governance score, right? Which then gets fed into our future leaders portfolios, which are our passive portfolios. So there's somewhere it can really add value and efficiencies and drive costs down. Somewhere we need to be wary for kind of moral judgments to be made by AI, unless it's really trained on some of the ethics that underlie us all, which I think we're still a little bit away from.
Yeah, possibly moving in the opposite direction, maybe even.
Exactly.
So there is still going to be room for human beings, and
I think so.
Yeah, good. Okay, great, fantastic. So still staying on that theme, really. I mean, you as a firm and we as a firm are both subject to regulation. We've got a regulator. We share the same regulator in the Financial Conduct Authority. We're not always popular amongst our peer group for saying that actually we broadly think they're doing a good job, and whilst not perfect, they are preventing a lot of harm. And that it's almost what you're not seeing that gets stopped, which is the thing to focus on, not perhaps where they're making mistakes. It seems to me that they are trying to get a handle on your industry a little bit more at the moment around the labels that not you but others have been putting on funds, the descriptions that have been used in the past, which perhaps weren't accurately describing what was going on in the fund. Obviously, when there was more momentum behind ESG and it was the in thing, some companies tried to pretend that they were doing something they weren't. So how's that playing out? The regulations have been changing. Has there been practical positive impacts from regulations so far within your sector and what you're attempting to do?
I would broadly agree with you that the FCA is taking a kind of admirable role in this. There has been greenwashing risk in the industry. That's one of the things that me and my team have been kind of cutting through for the last few years, right? For the people listening, there really was no minimum expectation for anyone to call themselves the best climate change fund ever. There was nothing attached to that. And I think that's what they're addressing, right? They're addressing the minimum standards that are attached to a marketing spiel, essentially. And I think that's completely right. And I think this is the anti-greenwashing rules, which are actually called that, are very good. They're principles-based, but they're very good because it gives a legal framework for people to challenge fund managers on their claims and therefore provide more transparency to clients, and clients can build more trust. And especially with the ESG backlash and so on, what we really don't want is more, people not trusting the industry and green investments or environmental investments when they think they're getting that. So I think, first of all, intention is super good. Second of all, what they've done is, yes, you're right. They've come up with, I guess, very key definitions of what is a sustainable investment and what is not a sustainable investment. And they allow funds that you can buy out there to label themselves such, and then therefore adhere to these criteria. I think they're good. There's 4 of them: impact, sustainable focus, sustainable improvers, and mixed. We see asset managers that we work with apply them. I think it's lifting the bar on transparency. There's more data being provided for clients. People know what they're investing in, what they're not investing in. I think it's starting to really take shape. The one thing that I guess we need to work on is that it doesn't yet adhere to overseas products, so funds listed in the European market, which a lot of our clients will have previously invested in. So there's a little bit of regulation, I guess, mismatch between these authorities, but I think that's going to be worked out in the years to come. I think it was time that something should happen. We are really supportive of it. The little implementation, of course, it will take time to all make sense, but I really do think it's a positive step.
Great. So is the net result going to be that there's going to be fewer funds that are allowed to brand themselves as something they're not? Will the marketplace for the kind of funds you're looking at shrink as a result of the requirements to label and actually do what you're saying on the tin?
We haven't seen it so far. So for all the funds that are on our list, they did apply for a label if they were UK-focused funds. So I wouldn't necessarily say that. I think most of the funds that were doing it properly will take that. There are some instances where the rules don't yet work as well. Passives being one of them. I think there's not, bar one kind of pension product, there's no passive product I know that yet has achieved a label, and I don't think that's realistic. EQ as a house doesn't think it's realistic. I think passive have a role to play. We just discussed this, and I think they need to be revised or refined to make space for the passive market, especially if you think about all the other value propositions that passive have, like the lower cost, the accessibility, the democratization, essentially, of the capital markets. So I think there's a bit of nuance to that. Still a little bit to work on.
So the existing labels, all 4 of the existing labels need to be tweaked, or we need some concept of something else in the regulations that enables that passive space? What's the solution?
It's the implementation guidance from the FCA. So funds can apply to the FCA for a label, essentially. They change their prospectus and then they go through a process and eventually they get passed. And I think in that process, there needs to be more guidance as to how a passive index tracking, data-driven approach could potentially align to a label or not. We're really early days. It's only come into place this year. It might be that it's intentional by the FCA. We're not quite sure yet that passives are so far left out. But I think there's industry pushes and consultations that allow us to voice those views, and we will continue to do that to hopefully create sustainable products that we can stand behind that do apply a passive approach.
Yeah. Brilliant. Okay. So last one for you, and therefore the most difficult. Where are we going in the future with this? Given that you, as a firm, have changed your approach, you've evolved your approach, you've broadened what you do. What's next? And that you can take that for EQ or the broader market. Where do we go from here?
I think we need to address the backlash to make sure that we reinstate some optimism to things that actually really are happening on the ground and that are positive still. sustainability isn't just one thing. It's not just windmills. Windmills might be, you know, Trump's pet peeve, but it isn't just windmills. There's many other sustainable themes, and companies are doing the right thing. And we think that the investment case still stands. So I think we just need to address the temporary ESG backlash with some optimism and some data and some real research to show that this investment opportunity isn't going anywhere. We're hopefully going to invest for the long term. I don't see a better future than a sustainable future. So I think that's what we need to instill. So we're working hard on trying to counteract greenwashing, to make sure that there's trust, counteract ESG backlash, to make sure that there's kind of the continued demand as being where clients want it. They are being met with the right solution, and calling out, I mean, what I'm doing a lot is calling out kind of US-based derailing from the sustainable ambition that we have, to make sure that, you know, ambition of the industry continues to grow.